Thank you very much, everyone. I hope you enjoyed your breakfast. And we'd like to reconvene the session. Thank you. I'd like to welcome to the stage Sonja Saunderson, a former colleague of mine. We've actually known each other for over 15 years. We worked at Momentum Multi-Manager together. And Sonja and I have interacted on a number of occasions within the industry, as well as within her position as Chief Investment Officer at the EPPF. Sonja has many years of experience, over 22 years of experience in this industry. She's been a lecturer at the University of Northwest. She holds a number of qualifications, including a master's in stats and economics. So join me in welcoming her on the stage. Thank you very much, Sonja. So the focus of this discussion today, ladies and gentlemen, is about how asset owners are adapting to changes to Regulation 28 since 2022, when the regulator increased offshore allocation from 35 to 45%. Now, as an asset manager, we've seen a number of our clients taking more exposure offshore. Sonja, how have you experienced this change? And what do you believe are the challenges that institutional investors, specifically retirement funds, face now that regulation has opened up?
Sure. It's funny, when the new Regulation 28 came out, I was actually still at Momentum. And I remember we were pleasantly surprised with the news to come out. And as I moved to a pension fund, I realized that the pension fund actually wasn't quite ready for this change yet. So it's a little bit that the industry has been advocating for more exposure globally, more allowable exposure globally. And then it's like catching that bus, and once you catch the bus, it's a little bit of, okay, now what do we do? Where do we go? Where do we invest? So I really think, the institutional investor landscape has been struggling to adapt to the fact that we've got this 45% offshore. It's a new realm, it's a new toolbox, so to speak, that's been opened up for pension funds. And what do we do with it? Do we have the right skills? Do we have the right service providers? Do we know how much offshore we should have? What's the impact on our local assets? What's the impact on our members sitting in South Africa if we put up to 45% of our assets offshore? So I think there's a lot of considerations. I think everyone is in a world where there's a lot of skepticism, as we know, in South Africa. Everyone's excited about the opportunity set, what it can pose for institutional investors, how it can enrich their risk-return reward from a pension fund. But there certainly is a lot of uncertainty around how fund managers are responding to it. Are all of them ready? Do we support South African fund managers? Do we support global fund managers? What does it do if money leaves our shores? What does it do to South Africa? Are we therefore almost being disloyal to the South African context and the challenges that we're facing? Should we rather invest in the real economy in South Africa? So a lot of those questions, I think, are what people are grappling with in the institutional world.
Yes. So from a South African perspective, and as a South African-based asset manager, well, I represent the South African-based asset manager, we've seen a lot of fee pressure across institutional clients. Is that something that is considered when South African asset owners are looking to invest offshore?
Oh, definitely. I'm surprised, again, coming from an investment management product shop into the institutional pension fund world. I'm surprised how acute that sense of costs are, that the value chain is getting squeezed and minimized. I suppose it was driven from a regulator perspective when default regulations came in, so it shouldn't be a surprise. And I think a lot of trustees and members and pension funds feel that that's the part that we control. You know, that's the part that's almost a sure bet. If you can save 1 basis point on costs, then you don't have to generate it from an alpha perspective, right? So,
yes.
So it definitely is important. Of course, it's not the only important thing. If you think globally, I mean, there's a lot of other things that I think pension funds are facing when we invest globally. In South Africa, they tend to know the fund management fraternity well. They tend to know the consulting fraternity well. They know the names. There's a level of trust in who M&G, who 91, who Alan Gray, who Coronation. You know, it's household names. People know them in the pension fund industry. once you start going offshore, I think there's a lot of, well, should we trust these people? Do they really understand what we're about? Are we becoming insignificant to them? Because all of a sudden you're investing in a hard currency somewhere else, but you're coming from an emerging market currency perspective. So even investors like the EPPF with a lot of scale in South Africa, when you go to a global perspective, of course, because of our currency, you're much smaller. So will you get the same level of attention? Will you get the same level of service excellence if you invest offshore? The biggest issue, of course, is your members reside in South Africa. So your liability, I mean, we're a defined benefit fund, and okay, granted the bulk of South African pension funds are defined contribution, but your liability, however hard or fast that is formulated, is in South Africa. Your members, the bulk of your members are going to retire in South Africa. What does it mean now that you're looking at assets from a global perspective? It may maximize return, it may help you manage risk, there's more diversification benefits. I mean, there's a lot more impact that you can create, looking at Alex's presentation earlier. But what do you do about your membership here? What do you do about your societal responsibility here, your corporate responsibility to the country? So all of those things play into it, but yes, we definitely can't get away from the fact that costs are one of the important considerations in investing offshore.
Thanks, Sonja. Just listening to the presentation from Alex earlier, it was clear to me that it's a very unique strategy. And I was sitting there wondering, do we have enough manager research capability in South Africa to be able to spot those, innovative, unique solutions that can assist us as South African investors to add value to our members, not just from an impact perspective, but as well as from an alpha perspective? I mean, I've talked earlier about us having a 4.4% savings rate in South Africa. It's scary. What are your thoughts on that?
Yeah, we're definitely sitting with different skill levels in different places. I mean, our fund is privileged that it has an investment team of its own. Some other larger pension funds also have that, but a lot of pension funds don't have that benefit. So they don't have dedicated resources that on their behalf can go and do research. Yes, you will get expertise in the market, either multi-managers or consultants or their partners that can help you. But it definitely sort of lengthens the value chain of you connecting with people offshore and knowing them. I mean, the weird and wonderful names that have popped up in my diary since I've joined the EPPF from overseas, that's wanting to see me, and it's outfits that I've never in my life heard about, and it's from all nooks and crannies in the world that's wanting to get assets from us. You definitely need resources to be able to scour the world. So what we like to do is we like to partner with overseas investors that themselves have the resources, the database and so forth that can look at it, but then we're very clear about defining the strategy that we want in the context of a pension fund outcome that we're trying to create, what that particular strategy entails, and then please go and look for the best service provider for me in the world that can execute on that particular strategy. So I think there's expertise that can help, but it definitely can't be the traditional game that we played in South Africa. And I also think that South African pension funds come from a very peer group centric perspective in South Africa, where even now still a lot of funds are managed on a balanced or multiple balanced basis. It's got pros and cons. I'm not trying to advocate for specialist versus balance, but the point is, if you are coming from a balanced perspective, now all of a sudden you can go to 45% offshore, unless your balance manager is going to go to 45% offshore, or understand the role that they play in your portfolio and the risk spectrum that could open up for you. The balance fund perspective may not be the most appropriate solution for you anymore. So yes, it definitely requires pension funds to think about what exactly it is that they're about, what they're trying to achieve for their members, to get the right expertise in the room, or to invest in the right expertise so that they are able to find these gems. And I think by and large, South African pension funds don't have that skill in South Africa right now.
I agree, and I think it's important that you would then partner with an asset manager that may have local expertise, but also a deep understanding of global capability and innovation. So moving on to the regulator. So the regulator, in my view, has caused some confusion. I'm not sure if anyone else in this room will agree with me, but they've now said, we're allowing you to take up to 45% offshore, but we're also allowing you to take up to 45% into infrastructure, because we understand that there's a need in South Africa and we need to invest into the country. How do you view that, and how are you actually managing this from an EPPF perspective?
Yeah, we were in a fortunate position that we already were investing in infrastructure, unlisted, so not a lot of listed opportunities in South Africa, although that's also something that we're trying to work on and looking for some innovation from a pension fund perspective. We're working with other asset owners to see whether we can't create listed vehicles that will help mobilize more of the assets in South Africa, and then looking for expertise to help us manage those assets. But that aside, we were in a fortunate position already to be somewhat in infrastructure, certainly not to the level of 45%. But from my perspective, the more there's an unfettered, open toolbox where you can use diversification as a tool, the better. So we definitely got excited about the fact that 45 offshore, 45% infrastructure. I personally don't see it as okay, well, there's now 45% in both places, global and infrastructure. Now let's do the interplay between the two.
Either or.
I actually think it's in a world where our listed market is shrinking, it's a little bit more, while my listed market is shrinking, I need to have a 55% exposure in South Africa in any case. Do I move to more unlisted instruments, private markets in South Africa? And what sort of unlisted instruments would that be? Is it private equity? Is it venture capital? Is it infrastructure? And in that sense, we're very excited that we can put more in infrastructure because our members are asking for it. Our members are asking that we think not only about their retirement. Of course, the first and foremost priority is the fiduciary financial return. And for them to be in a position to maintain their purchase power or to grow their purchasing power one day beyond retirement. That's clear. But then they're also asking us, and can we at the same time make sure that we have a healthier economy? That we think about financial access, where previously disadvantaged individuals in our economy now also has access. Can we also think about their children one day and the legacy that they want to leave as members in the pension fund? So what sort of country, economy, climate, even a world are we going to leave for them? So you pick it up in conversations. I mean, Europe is very strong and the developed world is very strong on climate change, for instance. When we started talking climate change with our pension fund, you could see a lot of people are glancing over and saying, well, that's not our first priority. Yes, it's maybe a little bit warmer outside, but we don't actually feel that effect as much as we feel the societal, the load shedding, and by the way, everyone, as much as we Eskom pension and Provident fund, I cannot switch on the lights. I do not know how that works. Please don't come and talk to me about that.
Please avoid any questions related to load shedding.
But yeah, so we were excited about it. I think there's a lot more there for societal, environmental, meaningful, impactful things that you can do by virtue of regulations allowing us more into infrastructure. But we equally as excited about the fact that we can go to 45% offshore, because now we can really dabble in a much wider pool. I mean, in the past, we, for instance, as a fund, had a lot of developed market exposure, a little bit of emerging market to complement us. But because we're residing in a emerging economy, we didn't want to just put too much in emerging markets. So therefore, we're very developed markets centric and also very equity centric offshore. But now that it's 45%, now you can really start thinking about other themes like infrastructure and property and a lot of other assets. So I think it's a good thing, but I think there's implications to it that people need to think through.
Yeah. So you touched on something very important, is that I think when following a specialist approach, most South African retirement funds tend to invest in the vanilla strategies that would give you a global exposure, not just focused on specific themes, as an example. We have other asset owners sitting in this room. So if you could maybe give some advice on when looking at their offshore allocation, how could they implement an SDG type of framework or an ESG type of framework within that offshore portfolio or allocation?
Yeah, I mean, there's many ways in which you can do it. I think SDGs is but one framework of trying to articulate outcomes from a consistent way that we're at least all using the same language. I think the first thing that is, well, since I joined the fund, that we spent a lot of time on was to try and be very clear about what's important to us. You know, what are we about? What sort of outcomes are we trying to create for our members? And those outcomes are not articulated in, well, in South Africa we want this and in offshore we want that. I mean, that's the way that we execute it, but they want certain outcomes. And those outcomes talk to more equitable societies, financial well-being, to a globe that is progressive, that is fair, where we can share health and fortunes together. And I mean, that's not South Africa or global, right? So I think you can be very clear about what it is that your sustainability approach is about and what you're trying to achieve. And that's certainly the journey we've been on. So which SDGs are important to us? Which SDGs do we think are the ones that we can meaningfully reach or impact? And also, which SDGs do we think really resonates with our members? Because you want them to stay invested, you want them to stay comfortable in their pension fund. And we articulated our sustainability approach around social matters, right? Getting more equitability from a social perspective, whether gender, race, I mean, lots of perspectives, but mostly those two. Then we talked about economic parity. In South Africa, economic parity, even the dispersion of how things were set up in the past, financial access, economic growth, all of those kinds of things will bode well for our members if we can help with that. And then the third one for us is that we think about environmental issues. So once you start spending time with members in the pension fund about why environmental issues matter, why the ozone changing or decarbonization isn't just a governmental issue or something that Europeans talk about. It's something that's real. It's affecting the competitiveness of our industry and the financial growth of our industry, and you know, whether our futures will be set in a particular way, how are we going to experience things going forward. But it's got real competitive financial implications. Then you start articulating it differently. And then I'm still waffling and not giving you the right answer. And therefore, in the global space, those same things matter. Yes. Those same things matter, whether it's in South Africa or from a global perspective. I do think that the globe is in a better position, or maybe developed markets, I should rather say, is probably in a better position to execute on certain themes like climate change, decarbonization, all of the investment opportunities Alex was showing, that is investable right now, where it's less investable in South Africa, at least in a listed format. And the reason being that they've gone through their industrialization periods and they're at a point where they can now start decarbonizing. In South Africa, for instance, we're still sitting with our just retirement, justness of the retirement perspective. How are we going to get the justness in the economy? How are we going to bring everyone along on that journey? I mean, our constituency of members at Eskom, obviously sitting there working at coal stations, are we going to put them out of jobs just because we want to fix climate change? No, we don't want to. We want to go through a just process. So all of those considerations mean that on certain things, you can probably put a little bit more emphasis from a global perspective than a local perspective. I also think, given our history of apartheid and, you know, the South African context, we certainly have a unique set of inequalities that we still need to address. Yes, we've made progress, but all of us know we're not there yet. So how do we think about the uniqueness of what is a priority from a societal perspective in South Africa right now that maybe is less of an issue from a global perspective? Global fund managers will talk about diversity, equity, and inclusion. That's their theme, and what does it mean? we know that we're sitting with much bigger issues here from a societal perspective. Yes, diversity, equity, inclusion is a good catch-all phrase for it. But we're still sitting with people that don't have access to basic services. We have people that, don't have education. We've got health issues. We've got, a multitude of issues that we need to deal with in South Africa. We're the most unequal society in the world. So will we implement SDGs the same way in South Africa than we do globally? No, we won't. We want to be more effective on certain things in South Africa than from a global perspective. But I think who you are, what you stand for, what you're trying to achieve is where I would start with, or advise other pension funds to start with.
Thank you with that. I fully agree. So I think it's about taking a strategic and focused approach as an asset owner based on your members and the needs of your members.
Sure.
When implementing your strategy across both local and offshore. Thank you for that, Sonja. So just going back to the listed infrastructure presentation earlier on. Now, for me, this is something that's a first that we're now bringing to this market and this industry. From listening to Alex, what do you believe is the investment opportunity set for the asset owners and asset consultants and multi-managers sitting in this room when considering their offshore allocation?
Yeah, well, with 45% that you can now invest offshore, it definitely is a much more compelling case to not just be equity-centric, because I told you we used to be in the past. That you can look at other asset classes, understand it more holistically, and also to very clearly some of the points that Alex made, to be impactful with where you put the money. You can get great financial returns, but you can also be impactful. So I'm very positive about, I, for instance, wouldn't prefer going into private or unlisted infrastructure globally, but I think it makes sense to go into private infrastructure in South Africa, given where we're at and where our market is and what we need to achieve. But offshore, I think it's a great opportunity set for various reasons. I mean, I didn't say it earlier, but as a defined benefit fund, we're always looking for that, and Alex made the point as well, like other insurers and other clients, we're looking for that long-term liability matching CPI sort of assets. That's one obvious investment reason. It definitely helps diversify, and also from a regional approach, it's not just concentrated in developed markets, it's actually capturing certain themes of areas where you can invest. So from a diversification perspective, I think something like that is appealing. But for me, the nature of it being listed helps a lot. I mean, although we're comfortable with whatever it is, annual or quarterly or whatever valuations, it's much better if there's a market telling you what something's price is on a real-time basis, right?
Yes.
So I think the whole price discovery around listed infrastructure is definitely much more appealing. You don't have to sacrifice on impact and what you can create from a listed infrastructure perspective. And I think the liquidity. Pension funds are always looking for liquidity. You need to make sure that you can get into and out of things. One of the biggest criticisms that we've had in our fund in going into unlisted investments, not just infrastructure, has been, what about liquidity? Our landscape is such that Eskom is possibly unbundling, and you may need to move portions of the fund to different areas. What do you do with liquidity then? So to have the ability to invest in real assets, all the investment potential that comes with it, without sacrificing impact. Yes, it may be impact more from a global perspective than necessarily focused in South Africa, but it's definitely very appealing for pension funds.
Thank you very much. So you joined the EPPF in 2022 as Chief Investment Officer.
That's right.
And firstly, I want to commend you and the team. You're one of the best run retirement funds in the country and have done a great job for your members. So well done. So you come from an asset management background, having worked at Momentum. So what would you have done differently, coming in 2022, having looked at their investment strategy? What would you have done differently had you been there 3 years prior?
At EPPF specifically?
Yes, at EPPF specifically.
Ooh, lots of things.
no need to share any specifics, but share what you feel comfortable sharing.
Hindsight is a terrible science. It's especially to to look at my predecessors and some of the things I inherited in the fund. But overall, I think it's a well-diversified fund. But I think there's been geographical concentration to some extent because of the old Regulation 28 not allowing for a more diverse footprint. But we bought into some ideas like, for instance, we had this developed market exposure globally, but we felt that China was always underrepresented in the indices.
Right.
It's the second biggest economy in the world, and yet it's not represented in the indices. Plus, from an asset matching perspective and going through our asset liability exercise with our consultants, we felt that we're missing out on the growth opportunity that possibly will help our fund. So that story, unfortunately, hasn't helped us a lot. So we probably have a little bit too much of a African rainbow story in our portfolios. That had mixed successes. Some of it worked, some of it didn't work so well. But geographically, aside from South Africa, of course, and some developed markets, I'd say not having the ability to look at other growth areas, frontier markets, the Asian markets broader than just China, for instance, certainly is something I would have liked to change. And then, of course, most of our assets still, global assets are still in listed perspective. So to look at the unlisted market is another area where we're looking at. So private markets, we've dabbled a little bit from a developed market exposure with the theory that private markets are mostly developed in those areas, North America and Europe, for instance. But if I look at returns globally, then there's definitely other areas that's got great growth potential for all sorts of structural reasons, urbanization and medical advances. I mean, there's the tech things that Alex was talking about. There's so much digitization themes, strong themes, that I feel like we've missed out a little bit on some of those opportunities. But fortunately, Reg 28 is helping us think about those things afresh.
Yes.
So those are some of the themes I think I would like to change with hindsight.
Well, thank you for sharing that with us. So one last question. So if you were the sole decision maker on the investment strategy of a retirement fund right now, and if SDG and ESG was your primary objective, what would be that asset allocation between South Africa and offshore, and then focusing in on how you would actually allocate offshore, given Regulation 28? What would you do?
I've got a cheating answer because I'm a defined benefit fund. My liability is sitting here. I probably will have close to 60 in South Africa for that reason, because we don't want to have an unmatched strategy too much. So we want to match the liability as closely as possible with the asset strategy. I suppose you're asking more in an unconstrained, not a defined benefit world. That's very difficult. It's again, hindsight will tell me I should have had much more developed market offshore exposure than South Africa. And even if it was emerging markets, don't just stick in South Africa, then at least have a broader basket. But I think given the Regulation 28, it's really up to pension funds where they see the opportunity. It's difficult to say, we don't think local offshore, what the percentages should be. Aside from the defined benefit realization, we don't think of it as two pockets. I mean, within there's so many subsectors of different asset classes, returns, geographies, and all of it. So we rather think within equity, local and global, how would we split it? And within bonds, local and global, how will we split it? So the continuum and the opportunity set, I think, has increased as a result of Regulation 28. So it's impossible for me to give you a perfect answer to that. But because of the fact that there's a real change in South Africa needed, because of Regulation 28 forcing us to still have a home bias, because of most of the members because of all of the members mostly in pension funds sitting in South Africa, except for a couple of people that have immigrated, of course, but mostly the liability is sitting here, and they care about what's going to happen with their financial returns, but also in the country that they're staying in. So I would say the majority I would still put here, even if it was an unconstrained regulation world, I probably would still have bulk of my assets here, but I'll definitely look for much more diversification from a global perspective.
Well, thank you for that, Sonja. It's been a pleasure speaking to you, and I'm sure everyone has enjoyed your valuable insights.